cool. Yeah, Vikram, I'll hand over to you. So anyways, if anybody who's new on the call, Vikram, you can set it up in more depth, but like Vikram loves technical analysis. In fact, if you go and listen to his TED talk, he'll talk about trading and all this other stuff. I'm now of the opinion that like there's no and I like to trade. I like to invest. Actually, let me just spend this minute here. The difference in investing and trading is investing, you really are looking like long term and not really worry about the short term price fluctuation. Trading is you're trying to make a trade really gonna say short term, right? But anyway, so Vikram was going to get feedback on charts and fund. This is really called This is called technical analysis, which is like the charts, and there's fundamental analysis, which is really we're getting some more feedback. Yeah, maybe you want to mute Amit. Yeah. There. So there's more fundamental analysis, which is really like, let's say, what's happening behind the scenes. So let me just spend 1 minute on fundamental analysis. So fundamental analysis would be unique addresses that own Bitcoin, right? So we're looking at technical analysis of Bitcoin, which is the price. The fundamental analysis are people actually owning Bitcoin on chain. And what that would mean is like, let's say there's only 1 million addresses, and then we go to 2 million addresses in 1 year. That means the number of people that use Bitcoin is doubled. But what should happen is Bitcoin is a network effect. You want to go from 1 million to 2 million. But you want the ideal number of addresses even growing consistently. And that fundamental analysis of the Bitcoin network can help you do a pretty good idea of valuation of how the network itself is doing. So over time, like so when I first got into Bitcoin, only like a few 100,000 addresses were on chain. It's like less than 1 million. Now there's, I don't know the exact amount, but there's like 30 plus million people that own Bitcoin on chain. So anyways, Vikram, I'll hand over to you. This is only one part of, let's say, the price. It's a technical analysis of the price versus the fundamental analysis of the price.
Yeah, and see, the thing is, this isn't a one versus the other kind of a thing at all. So in fact,
they're both important.
They're both important. Every trader even traders who call themselves pure chartists, pure technical analysts who say, the only truth is price, they'll still keep an eye on, not necessarily the news, but on fundamental data, not what CNBC is saying necessarily. A lot of traders will have CNBC on the TV in their office, but it's almost always for entertainment or just background noise, or to see what is in the news, so that they can know that, okay, it's over. If it's on the news, it's already old, is one of the kind of old traders expressions here. So I just marked up this chart here with a bunch of stuff. There's an acronym that I use. So anyway, technical analysis is based on the idea that human behavior has certain patterns, and human psychology, especially the psychology of a crowd acting together like a market, has certain kind of consistent, like repeating patterns to it, and that those patterns show up in the form, they can be documented on charts. So this chart is really a history of an ongoing battle between buyers and sellers, if you want, or between bulls and bears, all that stuff. Can you just type in the chart, into the chat? Any of you already use technical analysis at all? Look at price charts in any way? I mean, ZebPay's app has a charting feature. A lot of others have charting features. Somebody type in the chat if you use technical analysis, you do something like Fibonacci's or trend lines or anything like that. No. Neha Bonsle, yes. Anna, no. So some of the stuff I'll say is going to be very basic. And actually, it's not going to get much fancier than that, because I went through a phase where I tried every indicator under the sun and all sorts of, different things, wrote algorithms, bought algorithms, all sorts of stuff. Technical analysis or fundamental analysis are more important. Yeah, moving average, volume, candlesticks, yeah. So these are candlestick charts, yeah. So let me just show you, I marked up the Bitcoin chart here. This is the chart of Bitcoin from, I guess this would be April of 2019 through the present time. You can go back even further. It's fairly flat before that, and we know that it was even flatter and closer to zero in the years preceding that 2017 rally. So this is post that 2017 thing that happened.
Actually, if you just Vikram, rewind back, that looks like it was zero. It's not. So those prices back there, and just so you know, it's so close to zero. It is for a long time. Bitcoin. I'm going to kind of tell you what's happening for people who weren't around. In 2018, September, sorry, end of 2019 was flat. It was flat for a long time. It was right around, I think, $6,000. Yeah, if you look at that, yeah. So from September to here,
here's 6,000
for a long time, yeah. And everyone was like kind of saying, "Oh, they're calling it the Bitcoin stablecoin because the price is really stable."
Yeah.
Right. And look at that, for a good 6 months, other than that small blip up there, Bitcoin just traded right around $6,000, and it just stayed at 6,000. Right. And and then this is right before the beginning of crypto winter, right? When it went from 6,000 down to about, call it very roughly 3,000, 4,000, and maybe go down to that second leg down. Yeah, so right there, we'll price that. No, not that. Back in 2019.
Yeah, this is November 2018. The low was 2,900 something.
Yeah, it
just
touched
under
that,
3,000.
And then from my memory, it was around close to 4,000. So maybe they go up to this nudge higher. Yeah, right. No.
4,000
right
is
This
is 4,600 here. So this is 4. Yeah, this is 38.
Yeah, it was around 3,800 for a long time.
Yeah,
and it looks like a long time, but that this is probably, I could call it roughly 3, 4, 5, 6 months.
Yeah.
Right.
April,
and
November through April, it looks like. Yeah.
And my core point, it looks like it's not moving a whole lot. It's only because the scale is off, right? Meaning the same.
So here's in fact, I mean, see, and this is one of the things in technical analysis. It's all a matter of perspective.
Yeah,
okay?
That's my core point. It's people don't now look at it. You see, it's way more volatile, right?
And look at it without seeing that surge. So this is now between June of 2018 to May of 2019. And if you had bought here, if you had bought at 8,000 and saw it drop to 3,600, right? That's all those people who got out.
So to add on a zero, so it's the same thing as Bitcoin going from 8,000 to 3,600. The same time as 80,000 to 36,000. It's a different time scale.
Yeah.
Right. So all I'm saying is it's you're forgetting when you look at it, when you zoom out, you have a different perspective. That's it. So, sorry, Vikram, interrupt, but I was because it looks so different when you zoom out.
And actually, so see, this is a daily chart, meaning each of these price bars here represents the opening and closing and in between the high and low price of a single day. But you can see there are minute charts of Bitcoin. I'm going to mess up a whole lot. So, and people trade it. People who like very fast short-term trading, it's called day trading. Some of you might do that. And most people who work with charts will tell you that, most of us believe a chart is a chart is a chart. These kind of patterns, they exist. It's fractal, meaning that it exists on one small scale, and then you see the same thing on a larger scale. So you'll see a pattern like this, and you might see it on a similar pattern on an hourly chart. You might see a similar pattern on a minute chart. you might see a similar pattern on a weekly chart where, each bar represents an entire week's price action. And so the basis of what's called technical analysis, and I'm not sure there are a lot of fancy terms in trading, and that's one of them, is just looking at price. Now, I've deliberately put a whole lot of lines and a couple of different things just to show you a few things. You might hear some terms, and I'll show you just now. When I used to teach people how to trade, I used to use this acronym STIF. It stands for support and resistance, trend lines, indicators, Fibonacci, and fundamentals, because these are the basic things that most technical analysts use. Some people love to have all sorts of fancy indicators. There are programmers who will charge you thousands of dollars to make you an indicator, and the person who ends up making the most money from that will be the guy who sold the indicator to a trader who thought he had finally found the Holy Grail. There is no Holy Grail. That's one of the things you sort of learn. Anyway, so let's start with these light blue lines. These lines here are what are called support and resistance. Support is when a price drops down and then it reaches a certain bottom point and then starts moving up again. Okay, that's obvious. You can see that with your eyes. The key that you discover eventually in trading, and I'll just leave this as a simple point for you guys to remember, is the price dropped here because people became less willing to buy. Buyers lost interest. And those who already had Bitcoin, they were tired of having the Bitcoin and were ready to sell it. And so as they sold it, one of them sold it here at 4,900. And people looked around and saw that somebody had bought it for 4,900. And some buyers said, you know what? I can see a lot of people are desperate to sell. So if somebody got it for 4,900, I bet I could bid down to 4,700 and get it. And another one says, ooh, I could bet I could get it for 4,500, and so on and so on and so on. It's an auction, like any auction, until you reach a point where there are no sellers left willing to take an even lower price. The sellers have reached the limits of their, what you can call it, fatigue. Some people call it despair. Whatever it is, at this point here, this support point, what happened in the collective psychology was that the buyers kept saying, okay, this line here is at just 2,900 and something, okay? So some buyer was saying, hey, I'll give it to you for 28,500. I'll buy it for 28,500. Going once, going twice, nobody wanted to sell to him at that price. Instead, some sellers said, you know what? I think I'm going to hold on to my Bitcoin. And then at some point, a buyer was forced to say, okay, fine, I'll give you your 2,900. And that next seller who saw somebody selling for that said, you know what? I think I want an even 30,000. And the next seller who saw that seller got away with getting 30,000 said, I'll go for 35 and 31,000 and so on. And that's what makes rallies. The sellers suddenly get confident of being able to get a higher and higher price. The buyers suddenly get more and more eager to buy and are willing to cough up more money to get it. The word that's often used is called capitulation, that at any given trade, any single given point in time in a market is like a battle between a buyer who wants to buy low and a seller who wants to sell high. And one of them has to give in. Either the buyer has to come up to the seller's asking price, or the seller has to come down to the buyer's bid price. And some people will tell you, and I guess I'm in one of those, that all of this is just a way to try to understand that process happening millions of times again and again and again. And so it's all just psychology. Anyway, so support is a point at which, the price doesn't go any lower. Resistance is the opposite. It's the point at which, the buyers suddenly say, you know what, that price is just too high for me. And a seller is sitting there at, what was this price here? $67,000, almost $68,000, right? So some seller was there asking for 68.5 and finding nobody willing to pay 68.5 for it. And in fact, the buyers suddenly got aggressive and said, you know what? If you want to sell it, I'll give you 67.5. And that seller said, okay. And then the next one said 67.4 and then it started coming. And so if you think that it's all, I mean, trading is talked about in very rational sounding ways, but it's mostly, in my view, emotion, and emotion that's then sort of fancied up with all this sort of charts and stuff. Anyway, I'll just show you the other elements and call out your questions as you have them.
Vikram,
Happy to be interrupted. Yeah, Celine.
I'm glad you brought up this of emotion.
Mm-hmm.
How much of this is a self-fulfilling prophecy? Because in the news, you cannot miss hearing people talking about this is the resistance point and this is the support point. So how much of this is just a self-fulfilling prophecy?
Right. Let me show you a couple of things. I'll highlight these two support points in red so that we can see them, and I'll make them a little thicker. So you see these 2 points are virtually at the same price level, right? Just a few dollars off of each other. Now, as this price was crashing here in this wave, you can see my mouse moving, right? Can you guys see it? Somebody say yes.
Yes. Yeah.
Okay,
yes.
Okay, all right. Then I'll just, I won't draw circles on it. So as this crash happened not crash. CNBC calls it a crash. The news calls it a crash. We call it a buying opportunity or a correction. Anyway, between April and July, this price drop, everybody, okay, when a bad thing is happening to you, okay, or a bad thing is happening to someone, what do we do to try to figure out how to cope with it? We think back to our memory of a previous thing that happened that was similar. We think back to stories our parents or our ancestors told us. We think back to history. Traders are no different. As they see the price dropping, they start thinking, how low could it go? And the first question is, well, how low did it go last time? And last time was here, right? In January, it went to this level of 29.5 or so. And so, yes, there is a self-fulfilling prophecy in that most traders have access to the same price information. They all knew this was where it went. And so at a support level, and this is a known support level of 30,000 roughly, 30,278, okay? Everybody knew that's where the market stopped last time in January. So everybody was waiting to see one of two things. Will it stop there again? Or will people be even more ready to get rid of their Bitcoin and sell it off even further? And so what happens when you break a support level is usually you'll get follow through. And so there's one style of trading that's actually called breakout trading, when the price breaks through a certain support or resistance level, or it breaks past a trend line. These purple lines are trend lines. I'll get to that in a second. The market often moves with momentum, because suddenly now that support level didn't hold, is the expression that people use. And what it means is sellers seem to be more desperate to sell this time than they were last time. And if that's the case, a lot of buyers will say, well, if they're more desperate, I'm going to just wait for even better bargain prices. So the buyers will get even more aggressive in saying, no, come down to my price. No, come down even further, come down even further. And sellers will be looking around, and it's just peer pressure. They see other desperate sellers. They think, well, maybe I should be desperate too. Maybe I should be getting rid of this too. And then if you also see that some other market is offering a more lucrative opportunity, then you're like, okay, yeah, get rid of my Bitcoin for me. Take it. I want to go and buy, Ripple or whatever it is. So these are self-fulfilling prophecies. This one is an interesting one, just for from a trader's point of view. This resistance level, which I will make orange here, which was the top, meaning the top point of 64,000, roughly 65,000. that was achieved in April, 14th April of 21. The market dropped, and you see here that the market hesitated right at that level one time and pulled back for a few days, and then pushed back, and it pushed through. I mean, it pushed 64, 65, 68, $3,000 worth through. But once again, the buying pressure left off and it dropped once again. So the next time it breaks through, you're likely to see it go with even further momentum. You know, and
yeah, I was going to comment.
Yeah.
Guys, next time we hit that number, my opinion is it really just almost like punches through, and we'll see what happens. You know, if you want to remind me again when this happens, like, because like at that point, all the people who would have sold then, you're gonna see some people who bought that price, man, I'm out, but then everyone's been holding on for this time. It's just they're gonna hold on diamond hands, and you're gonna see some craziness.
Yeah, and you know, there are some ways to do projections. There's a Fibonacci extension projection, and there's this thing here, which is called the pitchfork. You can use that to kind of guess certain future resistance levels at higher points. But, you know, 80,000 is certainly kind of a given. And if you just, let me show you, this is the simplest kind of technical analysis. And this is usually all I do nowadays. I don't really do any of the fancy stuff, but take a line, draw it between the top of that previous, the top point of that previous top and the top point of this most recent top. And you see this upward sloping line here. You project this here forward in time, and you come up with, okay, at the very least, Bitcoin's going to hit 73, okay, as an initial starting point. Now, this is where you then go back to, you know, all of these, and the fundamentals of Bitcoin you cannot ignore. So it's not that Bitcoin's going to stop at 73 and then just putter around there for a while. I mean, Bitcoin is Bitcoin.
Vikram, could you just show us how you drew the bottom line?
This line here?
How did you arrive at that 73,000 figure?
Oh, because you take, okay, let me make this line a bright yellow. And then this is just eyeballing. This is very crude, and this is not really any kind of technical analysis to be called professional. But if I just project a line like this and say roughly here, see, because it's going in this zigzag, right? It's going down, up in a zigzag. And basically this orange line that I've drawn here is parallel to the previous center line of this up move here. And so you arrive at this point here, which is 74,000, okay? There are traders who will do nothing but this. And some of them are idiots.
Thank you.
I've known a few personally. Others are just sort of Zen-like, and they will also do a very simple approach like this. It depends on how you use that information. You know, that's a number, but whether you can trade at 74 or not, it requires a whole lot of other things. Anyway, I'll just point out the other pieces of you know, this these things that are on the chart here. These purple lines are what are called trend lines. A trend line is drawn very simply the way I just did that one, by connecting tops or bottoms at various points. Now, this is art. Sam, I think Sam once called it voodoo. A lot of people think it's bogus, and I would too, except that I keep finding that, you know, I'll draw it just sort of idly, and then it ends up working. I'll give you an example. This one surprised me here. Okay, this line, this purple line, okay, let me recolor it so that I'll make it green so it stands out. Okay, I drew this green line here when I was trying to gauge back here how far it would go. And so, and it didn't come all the way to the green line. It was about what, $200, $300 off. So I was like, okay, this green line's kind of not that great, because sometimes lines just hit precisely. Now this one here, I just left that green line there because I forgot to take it off. But there's something interesting that happened here, and it's kind of hard to see. Let me get rid of this. What you can't see, but if you've used candlesticks before, is, do you see a faint, do you see this faint thin line that's extending off of this? See this thick green little dot here has a thin green line coming down off of it. So what that means is the market opened here and closed slightly higher here. But in between the opening and the closing of when the day is counted, it dropped all the way to a low that is right here. And, I'm not telling you this is, people will tell you this is the reason to, like have blind faith in trend lines and use them. And, this is the, you get these courses and these charlatans saying, these are the trading secrets the Wall Street, insiders don't want you to know and stuff like that. It's not like that. But, sometimes I'll just be a little bit amused by how uncanny these lines can be. I've had lines where, I've taken my entry points off of here, but when Bitcoin, this last drop, when it dropped to just 30,000, just for fun, I left buy orders at various levels along here between 35 and 30, just thinking that, okay, I've got this line down here, this green line, and it could go, and all of them got hit. So, and in a sense, that's kind of, the end function of it is similar to dollar cost averaging, in that I just kind of bought at various levels in small amounts as it was dropping. So that part is similar to dollar cost averaging. I just happen to also be looking at charts at the same time. So anyway, these things are called trend lines, and they have, this one here is at an odd angle, and you might be wondering where the line comes from. It comes from connecting a low from a single point here and a low from a single point here. Not everybody.
That's a good side point. Is it when you're putting in, guys? So when you're buying some of these things during either bull markets or bear markets, and actually, why don't we start by this way? July to November was a kind of a bull market, right? Yeah. And November up until just a few days ago was a bear market, right? We went from 70,000 all the way down to 30,000. And now the question is this a bear market rally? Meaning that, are we rallying in a bear market, or have we turned back into a bull market? And that's what we don't know yet. Mm-hmm. But the reason I'm saying is that when you're putting those limit orders, how are you deciding, what entry points, and how did you do them? Did you put more? See, let me tell you what I do, guys. If I'm making a long-term position, let's say I have $100,000 and I want to invest it. What I will do is I'll take half that money, $50,000, and put it at what I think is the best price, that where that green line would be, right? And then I'd put $30,000 a nudge higher than that, then like $15,000 a little nudge higher than that, and then like 10,000 and 5,000 at higher points. So if you look at how I'm buying it, that's how an order book looks. Is it most of my money is I'm trying to buy at the best price. This is going into a bear market, right? Yeah. Because I'm buying it as I'm more confident to buy at the cheaper price, right? But that's very different from what you want to do in a bull market. In a bull market, if you should be in a sense moving the exact same thing on the flip side is your sell targets are at higher prices, right? So maybe we want to talk about what you did in a sense.
Almost the same thing. It's the same mentality, Rahul. You're doing it though, basically without drawing it out on a chart. But yeah, because the further down it is, the more of a bargain it is, and the less likely you're going to return to that low of a price. So yes, you want to grab while you can. I mean, it's like, it's the once a year sale of something, then yeah, you want to stock up. But yeah, I mean, there are traders, and I used to do this, who try to pick the top and the bottom. You try to guess. And a beginner trader would do exactly that. They would say, okay, the support level in January of 21 was here. So I'm going to make a bet that it's going to come back to that same support level. And they call their broker. Well, in the old days, they'd call their broker. Now they just place an order for that exact same price. And their entire buy is at that exact price. But it'd be much smarter to start buying as it's dropping. And if you're lucky enough that it does hit that, buy there. But you don't want to, I mean, suppose it shoots down all the way to 25,000 or 20,000, right? And you already spent all your money at this 29,000 level. Then you'd feel like an idiot because you would have bought at this price and watched the price of Bitcoin continue. So what you bought is already in a losing trade. But if instead you're conserving your, cash and able to buy further, and then able to buy also on the way up a little bit as well, you're sort of buying all through the roundedness of the curve. So it's not that's not a simple strategy. It's more just a way to think about it. Just the key to thinking of it that way is accepting that you don't know what the bottom of the bottom price is going to be. Nobody else knows what the low price of that thing. Nobody knows when the market's going to turn around. We can call it bear market rally, we can call it turnaround point, we can call it all sorts of stuff. But the only thing we know for sure is that we don't know. And so successful traders trade with the knowledge that they're not going to be right. But I mean, most successful traders are right about the markets less than 50% of the time. At least in the short term. Long term, to say that Bitcoin's going to go up and eventually go to $100,000 and beyond. Yeah, I mean, I think everybody thinks that. No. This bear market rally, there's actually one line we could draw right now. And shall we just wait and see what happens and see if we...
Yeah,
this would be the line right here, is connecting this top and this top right here. So a trader looking at those two would say that Bitcoin is either going to go up to this purple line that's here, which is also a line from this pitchfork here. So that means it could rally to a 45. Potential resistance point of about 45. And that line makes sense because, here, let me draw a horizontal line at 45. Oh, this is good. Okay, this is exactly how it is. Okay, so look at 45 here. If I draw a line just under right there, okay? Now look back here. It was a support point here. 45 was a support point here. 45 was a support point here. So, and 45 was a support point almost right here. So this is a significant level. It's a significant level because you see just above it, a whole lot of battling back and forth between bulls and bears, And so any place that is a battleground between bulls and bears is probably going to become one again. And that's right here. So shall we just see if any of this stuff works? Let's see if it tops out just under 45,000 and then turns back around and heads south. And maybe goes to
so what if we continue the bull, if we continue to go upside, you think it hits 45. Mm-hmm. If it 45 tops out, then where does it go? Where would be a buying opportunity?
The buying opportunity seems to come down here, back to this good old green line and this other purple line. So this would be 34.5, and then below that, 28. But this is where 28 is technically possible. It connects to an old, nice line from these two old low points here. And the thing about when you have a market that shoots up like this, silver does this sometimes, is the lines that you draw. Remember before when we said about how the perspective changes when you when you go back in time and you see that, what look like small moves now were actually big moves, relatively speaking, back then. So this purple line here stops also at 28. So this is by no means trading advice, okay? Please do not take it as such. I'm not planning to take my own advice actually in this. I'm going to do something a little more conservative to buy some Bitcoin on this. But 28,000 is theoretically possible, but the fundamentals of it say,
Vikram,
I don't know that it's going all the way to 28.
You're saying you let's talk about actions versus kind of. So what are you doing, and tell us why, or what do you think?
I would.
If I guess, actually before you go, guys, what I do is I just buy and don't sell. So now, but what I mean by that, I use technical analysis in the way is I buy more at the bottom of those charts, and I try to buy less at the top. Mm-hmm. That's it. Yeah. But yeah, sorry, Vikram, go ahead.
Mine's probably just a variation. I buy way less compared to your less, and I would probably, at this point, I would just wait for a turnaround here. And if it is a rally, then I'll rethink it. I mean, if it's going to just rally straight up to 50,000 from here, which it could, I'll buy some. But if it does turn around at these points, then I'll buy significantly at, this little level here. That's one. And again, if it retouches this bottom here, then that's one. And if it breaks through this, then you can, I would just keep buying little by little as it drops, because you don't know how far down it'll drop, but 28 seems to be a possibility. Let me show you just two other features here. This is a trading.
Sorry. Yeah. I agree. At 28, guys, I think there's a lot of support, meaning that we could hit 28, but I don't think we break it.
And that, whether you're looking at fundamentals or, just the chart, you see how they line up. And in a sense, this comes back to Zillian, what you were saying about self-fulfilling prophecy. It's a whole lot of people having the same kind of access to information and also the same mentalities. So, yeah, and the same fear and greed. That's the other thing. All right, so this thing here is called a pitchfork. The way to draw a pitchfork, let me delete this and show you. It's kind of on these modern charting software. In the old days, the really old days, and I knew some old traders who would tell me, I used to draw this by hand with a ruler and a straight edge and a pen on paper charts and stuff like that. So you take a previous high or low, and then you have a low and a high at which you draw these two lines. And then, so the perpendicular that intersects comes down this way. And what you can see from this pitchfork is that this decline in price as just now, the low is also the midline of this pitchfork. Now, is that also a coincidence? Some will say yes, some will say no. But there it is. It happened to hit the midline, and now it's rallying up. And look at where the next line of the pitchfork is. That same level, that 45 level. So this is a significant number. When it reaches that, let's see what happens, because I'm not the only trader looking at charts like this. A whole lot of them are. And it's not just human traders in crypto anymore. Algorithms came to dominate futures trading. Like 70% of all the trading volume in index futures, crude oil futures, a lot of commodities is done by computer algorithms. Humans have a minor role in the trading action. But the algos behave just like humans because they're programmed by humans, except maybe that they're a little more extreme because they're emotionless, I guess. So I got to learn a little bit about algorithm trading back in like 2013, 2015. Oh, and the other one. This is one of my favorite mathematicians. So this is a Fibonacci retracement. Fibonacci was an Italian mathematician in the 13th century who brought Indian numerals to Europe and the concept of zero, and really the decimal system as well, along with this number, 61.8, which is, the Greeks call it the golden mean. It's a number you see repeated in nature in all sorts of places. And it's applied in trading. Don't get me started on Fibonacci. There's some great videos I can share if you like. But the reason Indians should be interested in Fibonacci is most Westerners, they think Fibonacci invented something. But in the opening chapter of his book, Fibonacci himself says, this is a book which I've written for my fellow Europeans to bring to them the glory of Indian mathematics. I have done nothing original here. I have simply been privileged to have teachers. Most of those teachers were Arabs and Berbers. And I have studied the mathematical systems of the Persians, the Arabs, and the Indians. And of all of these, the Indian is the most supreme. And so he brought it to Europe, including the golden mean, including the Fibonacci sequence of numbers, including a whole lot of mathematics based on that, and the 1 to 10 system of math that the Indians were using. A lot of what he did came from the Indian mathematician Pingala. So if you're interested in the history of Indian math, that we can talk more about it later on. But here, the simple use of a Fibonacci retracement is this. I've got a whole lot of lines here, but you draw from the low of a rally up to the top of a rally. I could even draw it to this, just encompassing the entire rally from back there to here. And you see that the market did 61.8% retracement. The market has just done a 50% retracement of this big move. And 61.8 sits at 31. 78.6 sits way down here at 22. But this line I don't like so much. If I was going to draw a Fibonacci, I'll just put it back to the way I had it here, because this one is the way I think most traders, most analysts would use Fibonacci. You draw the line low here. Now you could take it and draw it back here. I think when I was beginner, I would have drawn it back here. But this rally here is actually a very complete cycle. So, and this is a matter of opinion, and some would say art or just superstition, but I like the line here. So I'm just putting it here. So you draw it, you look for any market that's gone up with a long sustained rally is going to retrace. It'll retrace to the 50% level, and you see that it did, and it stayed right here with buyers and sellers battling it out. The sellers won, and it sold off even further, and it landed where? Right at the 61.8% line. Now, that's another self-fulfilling prophecy, but it's also 61.8 is actually a number that you see in nature so often that it has something to do with human psychology. And even something to do with human physiology. You see, anyway, I won't go on because it's an endless topic. But so Fibonacci, pitchforks, trend lines, support and resistance, and indicators. There are, as you can see, thousands of fancy indicators. Almost all of them are based on a couple of simple things. One is a moving average, which is just an average, but the average is updated to take in different numbers at a different time. And the other is some calculation done based on those moving averages. A popular one is called the stochastic indicator. Stochastics famously, just before Bear Stearns tanked in 2007, starting the financial crisis, Jim Cramer of CNBC very famously went on his show, and he talked about how he was so bullish on Bear Stearns. He was telling people to buy Bear Stearns, and the reason he gave was that he had a proprietary stochastic indicator that was telling him Bear Stearns was oversold and therefore a great buying opportunity. And so he quoted stochastics. Everybody said stochastics, what a fancy sounding word. And Jim Cramer's on TV, so he must know things. And between those two things, You can do two things. One is you can get a lot of people to make a very bad decision, like buying Bear Stearns stock just before the financial crisis. And you can also use it to impress people at cocktail parties. And so you will see young traders and trading bros often talking about how they look at
is often used for like when it's oversold or overbought.
That's what it is.
Right.
See, when it's inside this purple range here, that means it's neither oversold nor overbought. When it peaks out it's called oversold. And when it's out here, it's overbought.
So this is what I'd say. So yeah, go back to the purple line, guys, for everyone. In those purple lines right there in the middle, that's when you want a dollar cost average. So let's just talk about like, so let's just say you're a long-term investor like me and you're using technical analysis. Is in the purple line, you're buying one at the day. Like this, imagine you could afford one at the day, which even I can't. I could a long time ago when it's cheap. And you can buy one at the day in that purple lines. And then when it gets called oversold, which is the bottom of that, right? That's when you want to lean in and you want to buy more than one at the day. Okay. And at the top, that's when you're like, you know what? Like, I want to buy 0.1 at the day at the top.
Yeah.
Right. So it's kind of like you're buying 0.1 above the line, you're buying 1 in the purple lines, and you're buying like 10 at the day at the bottom parts of that line.
Yeah.
Right.
Now, the thing about it though is you need to have the kind of nerves that Rahul has, and you need to have the kind of staying power mentally and financially, because look at this. Okay, let's take this point where Bitcoin reached what was then an all-time high, right? $40,000. It had been overbought supposedly from all the way back here at 20,000. So between $20,000 and $40,000, literally half of the price movement, it was overbought. And beginning traders and people who just don't know better will say, oh, it's overbought, you shouldn't be buying more. It's overbought, you should be looking to sell. It's overbought, you should be looking to take profits. And so when it hit overbought, there were people who sold at 20,000 and sold at 21,000. Do you know who they sold it to? Smart traders who knew that when you break out of a resistance level, which this little thing here is, you tend to have momentum. And experienced traders who know that a market can stay for days, even weeks, in overbought or oversold territory and just keep on moving in whatever direction it is. So yes, exactly. Rahul's advice is spot on, but just remember, you might buy in this oversold territory only to find that, like here, it was oversold here, right? And that's where 44,000. So Rahul would have bought, right? And you did, you bought ETH here, right? And then it went further down. It actually stayed in the purple, but some of that stuff, some of the ETH that you bought at this range here, Rahul, it was losing money, right? So, but you had a long-term strategy where that losing money on those, balances out by all the gains from everything else that happens. So again, I mean, in case I haven't made the point explicitly, I'm talking about technical analysis, but all of this is really proof that dollar cost averaging does work. Just as Rahul says, you can just do the math. I mean, there are mathematical proofs of it. The mathematical proofs are here. Technical analysis is a nice complement to that. And it does work for making short-term trades along the way. So I do a split of
another thing. So people want to know, obviously there's different charting software. Do you have any recommendations on things you like on charting? Like, are there?
The one I'm using right now is called Altrady, ALTRADY. Unfortunately, it isn't compatible with ZebPay. It is compatible with Binance. It's connected to my Coinbase Pro account. But the charts actually, Altrady is just it's using charts by TradingView. So if you want to just do some chart analysis, and then make your trading decisions separately, then I highly recommend TradingView. Yeah, TradingView is really cool. And actually, Ria, are we still planning to use TradingView charts in the ZNU? Is Ria still on here? I saw her earlier. I know we were in talks with them. Okay, we were talking to them.
But I think we are using TradingView.
When Ria first joined, we started talking about that, and I think it'll be a great move, and I'm glad to see that. All right, so this is the messed up Bitcoin chart. This is an indicator called the MACD. I actually kind of like it. I don't really use indicators anymore, but back in the day I did. And it's just a variation of a calculation. MACD stands for accumulation and distribution. And honestly, it would take too long for me to do that. But you saw that there are a ton of different indicators, and now there's one called Bitcoin kill zones, which I saw, which just drew a big stain across my chart, so I didn't understand it, so therefore I deleted it. But shall we try this? I've got a blank ETH chart here, and as you can see, it looks pretty similar to the Bitcoin chart, doesn't it? And so if I was just trying to just look at a chart and didn't really know anything about what it was, and the first thing I might do, since I see this rally happening, I would connect these two tops here just to kind of see, like, hey, this is heading up there. Is there any line that could stop it or make them make the traders stop to think a little bit? And this would be one at 3,600. Then I might think, okay, if it drops further, where's the support? And this is just a matter of personal taste. I tend to draw angled trend lines more than I draw support lines. Let me see, let me get the exact low. Okay, so there's a thin line there, there's a thin line there. Oh, look at how beautiful this is. There's a thin line on this red marker here. Let me see. And so
if you look on the intraday, it actually touched that.
Yeah, it touches it, and then look here,
it touched it,
it touched it and popped up.
And then ramped up.
Yeah.
And so if you're wondering, guys, you can see right there, meaning that the resistance at 36, 37, yeah.
Yeah. Oh, actually, let me see. It may not be that perfect, but it's pretty close.
This is also not. It's not like law or guaranteed work.
No, but look at that. That's it. See, this is when I mean, I'm constantly skeptical of my own technical analysis, and then something like this happens, and I'm like, damn, that's just beautiful. I mean, look at that. 3 points in time, February 21, and then July of 21, and then January of 22. And the collective wisdom stopped the market at these 3 points that connect on a line. You can say it's coincidence or you can say it's not. And I guess either way you're right, because you'll make decisions based on it. But so this is a little wedge here in Ethereum. You could also possibly draw another line. See, this is so steep of a drop. It's a little tricky to draw, but this might be a true line. So this may be another level here. But these two lines are the ones that I would do. And honestly, I wouldn't draw too many more. You could do a Fibonacci retracement. Let's just do one, just so you can see what a genius Pingala and Fibonacci. Fibonacci, his name was Leonardo. Nobody knows his actual last name, but his father's name was Bonacio. And Fibonaccio means the son of Bonacio. And so, yeah, so the market has basically Ether has retraced its move from July up to November by 78.6% roughly, which is a deep retracement. And a lot of times deep retracements are like when you pull a bow back as far as it can go, you build up a lot of tension. And so if that's the case this time, then it's built up a lot of tension and ETH is ready to, as soon as it's done figuring itself out in this wedge space here, could go a long way. None of this is to say that one trading decision is better than another, though. But see, the thing is, a lot of technical analysts, like when I published, I always, and I know our trading team also tries to do this. They give both the upside and downside possibilities. They don't try to like show a prediction one way or the other. So here's a chart for BAT. It's not that dissimilar. I mean, it's kind of similar from it, but anyway, I want to know if you guys had any charts you wanted to call out and look at. Uni is very different, obviously, because Uniswap has had its own journey, and it's kind of interesting that it's this low to me, given the kind of market cap that Uniswap has. I mean, Uniswap is like a gigantic beast of an entity, and so it is kind of puzzled. Hey, see you, Rahul. That's right. Yeah, I know we do have TradingView in the current Pro. There are some new features that they have now. TradingView is offering, and AllTrade has some of the things that only like app vendors can access and things like that. So there's some cool stuff there. So that's kind of it. Actually, I've been looking at Matic. So that's the chart that I'm puzzling over. I haven't drawn any lines on it yet. But that's because Matic is giving great returns in DeFi also. It's like 12.7 or in some places 8 and 9. It's giving as good returns as stablecoin right now. So I figured it might be good to have some Matic and then earn interest on it, and also earn interest and also have it in a growing asset or a potentially growing asset. So that's why I'm trying to look at Matic now. I haven't drawn any lines on it yet. Anybody want to see a chart? Anybody want to? Oh, we're out of time. Anybody want to just go ahead?
I actually have a quick question for you.
Yeah.
Do you always use like the daily charts, or do you use like 15, 30 minutes,
It depends on the kind of trade. Actually, it's because the nature of the time frame in which I'm looking to hold on to these assets in crypto.
Yeah.
If I was day trading futures, then I would use time charts down to 5-second charts. And I also trade futures options, and for those I like I like to trade one style is to trade out of the money options on markets that are at real extremes, particularly extreme highs, like multi-year highs. So for that, I'll use a weekly or a monthly chart even I'll just scan all the monthly charts of all various futures markets every so often, and anything that looks like it's headed towards an extreme, I'll start looking for possible option trades in it. Crude oil is one right now. I had a trade in cocoa a couple of months ago that was like that. Anything else?
Yeah, you're right. I guess we're over. Yep. But thank you, Vikram. It was awesome. I actually enjoyed listening to you speak.
Thank you, guys. Thank you all for coming. If anyone has questions or stuff, I'm happy to show you, or maybe we can do another session like this. Let's watch Bitcoin's. Let's see if 45,000 holds as a resistance level, and then we can maybe meet back and look at what's going to happen then.
Vikram, I am always inquisitive about one thing. They use a term called dead cat bounce. So how do we know that it's actually not a rally ahead, or it's just a temporary?
A dead cat bounce. Yeah. So in the days of a live trading floor, particularly in futures, you would usually, for dead cat bounces, you would look at the volume. And so if there was not a whole lot of volume and if the price was rallying, but there just weren't a whole lot of participants there, then it means that a few people are driving up the price and everybody else is just sitting on the sidelines, not committing. And that can sometimes, so the markets become thin for a few days. In that case, you can sometimes get a bounce. It's just because, somebody's bidding it up, somebody's selling to them, the price gets, recorded, but most people are just sitting and not trading and just watching it. And so it'll come down just as fast. So you can watch the volume. That's one way.
Okay.
Yeah.
Sure.
But the other is, don't try to guess whether it is one or the other, because volume can suddenly just come in. A dead cat bounce can start a rally, and then somebody will say, you know what, let's just buy. And for all sorts of reasons, somebody, in stocks or, hedge funds, sometimes at certain points in the quarter or at the end of the quarter, they need to rebalance their portfolios. So they will buy at odd prices, not the lowest price, just because they need to own more of that stock or that asset. And so,
Too many things to consider.
No, but that's why for most people, dollar cost averaging, and then keep it simple if you're going to use technical analysis. Just look for points of support and points of resistance, and know that the market is going to, everybody in the market is going to be aware of those, and possibly do something at those levels. So it's a way of sort of not flying blind, right? But you should never look at a support point and say, okay, I'm going to just buy with all my money right here, because it's quite likely that it's going to drop below that and you'll be in a losing trade. Maybe another time I can tell you about the Turtles, who were one of the most successful groups of traders back in the 80s and 90s. So the best Turtles had like 80% returns, and they were somewhat technical traders, but they used what's called position sizing, which is basically similar to what Rahul talks about with dollar cost averaging. So, and it requires a stomach. You have to be, the Turtles routinely took 40%, drawdowns and more. But because they had a sense for the longer term trend and they were willing to hold on for that, they were fine. I knew, there's a great old book called The Market Wizards. It was written in the late 80s. It was profiled some of the best traders like Paul Tudor Jones and a few other people like that. And I actually knew one of the Market Wizards. He was a friend of a friend. He was a friend of the CEO that I worked for at the time. And he was in a crude oil trade, and he was down $25 million. And his net worth was probably $200 million at most. He wasn't a billionaire yet. But he was fine. And after being down $25 million for 6 months, crude oil rallied, and he made $70 million. Wow. That kind of guts, not many people have.